Welcome to the Asia Climate Finance podcast, where our host and expert guests delve into and scrutinize the pressing issues and emerging trends in climate business and climate finance. We greatly appreciate your support. Please like, review, and subscribe to the podcast to help us grow and reach a wider audience. Be sure to take note of the disclaimers at the conclusion of each show. And now, here is your host, investor, analyst, and author, Joseph Giacobelli.
Good morning, good afternoon, and good evening, wherever you may be, and welcome to the 65th episode of the Asia Climate Finance podcast. In this episode, I speak to Srini Nagarajan. Srini heads Asia for British International Investment, BII. For those of you not familiar with BII, it is the UK's development finance institution. It is focused on investing in sustainable infrastructure and businesses in developing countries to promote economic growth and support the UK's development goals. Between 2022 and 2026, BII plans to allocate at least 30% of total new commitments by value to climate finance. It already has investments in almost 1,500 businesses across 65 countries in emerging economies, with total assets exceeding $10.9 billion. The conversation with Srini covers the critical role of financial institutions in Asia's energy transition, actions government can take to attract foreign investors, and the intersection of inclusion and climate finance. Now, Srini provides insights into BII's strategies, including investment in funds, direct equity investments, and also the importance of blended finance. He also highlights successful examples from India and Southeast Asia. Enjoy the discussion, and please do email us to suggest topics for future episodes. Again, enjoy the discussion. Hello, Srini, and thank you so much for making the time. I know you're traveling around, a busy person, so we're actually recording this on a Sunday, so I really appreciate that. How's everything at your end, Srini?
Very well, thank you so much. Thanks to you, Joseph, for accommodating me on a Sunday.
Oh, no problem. So maybe we can start with just a little bit of a personal introduction. I mean, we have your bio in the show notes, but could you tell us a little bit about yourself and also how kind of you got into being interested in decarbonization and energy transition related investments?
Thank you for this opportunity. Let me introduce myself. I'm Srini Nagarajan. I head Asia for an institution called British International Investment. And I joined BII, it used to be called CDC earlier, Commonwealth Development Corporation, in the mid-90s, and have been in the development finance world for a long period of time now. The reason why development finance world, it's been absorbing me for a long period of time, it's because we really make a change in the lives of people using our capital effectively. It's extremely gratifying to work for an organization where you really change the lives of people using your capital very effectively. And the whole thing about climate change, the organization's commitment to climate change, and with an annual investment of around 30% of its total investment commitment every year going towards climate change, particularly in the emerging markets, is also one of the other great reasons which kind of motivates a person like me to stay on in the organization and find new frontiers of what one could accomplish in the area of climate change. The reason why I'm saying that is our job is to be much more catalytic in nature, which allows us to find newer frontiers by taking greater levels of risks vis-a-vis a commercial lender. That makes us very special as an organization. So that's perhaps one of the main reasons I've stayed on in this role for a longer period of time, in this job for a longer period of time, and this wonderful institution as well.
And before you joined BII, what were you doing before then?
I was a commercial banker, an investment banker and a commercial banker, and more in the area of merchant banking those days, an area of capital markets. And in the mid-90s, when I really saw CDC in action then, now BII, in Africa, where they used to own companies and run it, and I really saw that in the 8-9 years I spent in Africa, I really saw that there were really making a change in the lives of people, principally by owning majority stakes in companies, training up locals in various countries in sub-Saharan Africa, and getting into some very, basic industries and very, very important for nations like cement, sugar, plantations, etc., and also thriving these economies. So that really shifted my thinking towards development financial institutions and how they are able to drive these economies and how they're able to, bring this change at scale. That's probably, that really motivated me. And their ability to find a pathway for commercial investors to come in later and fund these various companies which they started, nurtured over a period of time, is one of those main reasons that this makes it a very special organization, I would say.
Right. So we're going to be discussing today 3 critical topics. One is the participation of financial institutions in Asia's energy transition. And secondly, government actions to attract foreign investors in the energy transition projects. And last but not least, the intersection of inclusion and climate, which I think is a topic which is not necessarily very often discussed. So first, let's look at, the first area. What are your views regarding the participation of financial institutions such as BII in Asia's energy transition? I mean, how critical is it for the growth of energy transition projects in the region?
Let me take one step back and give you a little bit of background about this, the current state of BII, which then I'll put the context in there. Given our long existence since 1948, or the last 70 plus years, and our mission of being additive to commercial investors and not substituting them, we have the ability to come in early, take early stage risks, mobilize commercial investors to scale the whole business. And BII is a very experienced investor in climate finance, having committed more than $1 billion over the last 2 years to fight the climate emergency. Now, in this whole context, I think, Asia is crucial to the global climate efforts due to its rapid growth in energy demand, driven by urbanization, industrialization, and living standards. If you try and take one step back and see, most of these emerging markets are in a conundrum between aspirations to become a high-income nation and reduce emissions.
Right.
And you actually need a balance to achieve the net zero. And something like a just energy transition program, which the UK government is supporting in countries like South Africa, Vietnam, and Indonesia, helps you a lot in becoming more and more disciplined about emissions, really. So Asia is crucial to global climate efforts to its rapid growth in energy demand, driven by urbanization, industrialization, and Asian energy demand is increasing as one of the fastest growing in the region. As a matter of fact, as per the International Energy Exchange estimates, the region's primary energy demand will grow by 1.8 times by 2050, and renewables in the whole power demand will grow by 4.4 times, really. And Southeast Asia, as you know, despite the rapid growth, the reliance on fossil fuel is quite high. And as a result of which, given that nearly 80% of Southeast Asia's rise in energy demand has been met by fossil fuels since 2010, the climate impact per dollar invested in the region's energy transition is amongst the highest globally. And to address this growing energy demand and reduce dependence on fossil fuel, 6 Southeast Asian nations, including Indonesia and Vietnam, have announced net zero emissions and carbon neutrality targets. These sustainability ambitions require at least $200 billion of energy sector investment by 2030, of which over 3/4 needs to be channeled into clean energy. If you try and understand what do investors look for in a region, there are 4 factors. One is policy consistency. Second one is linear and predictable deal flow. Third one is smooth execution. Fourth one is talent. Fifth and the most important one is track record of having made money. And I think in most of these boxes, if you're able to tick them consistently, natural flow of commercial capital is inevitable. Southeast Asian nations are in this journey, and they currently have limited bankable opportunities and quite a mixed regulatory and policy framework. And it's a journey, of course. All these nations are taking a lot of efforts in this directions, but it's a journey. India, for that matter, is a little bit more advanced amongst these markets. And China, of course, is in a very different league. So as a development institution, this is where we really come in. We take a longer term and flexible approach to de-risk projects, demonstrate viability, and encourage market participation to mobilize capital and maximize development impact. So that's exactly our role, really. Taking on your other part of your question in terms of our own activities in the region, as a part of our 2022-26 strategy, we have committed, as I said earlier, around 30% of our annual commitments by value in climate change. And some of our notable investments in Southeast Asia, the way we look at all our investments in Southeast Asia is in 4 parts. One is we approach it through the lens of as a limited partner and invest in climate transition funds, where we have done funds like SUSI Energy Transition Fund, we have done CSEF Climate Capital, we have done Wavemaker Impact, which is more like a climate tech fund, we have done Navis, which is more like a private credit fund, and we will be shortly announcing one more fund. Now, all these are funds set up by very accredited fund managers through which we look for very active co-investment opportunities. Second methodology which we invest is directly through platforms. These are direct equity investments. BII is slightly more specialized there. We have the benefit of having established platforms across our markets, both in Africa and Asia. In Africa, we own 2 large platforms. One is an IPP, a company called Globalec. We own 70% of. And the other one is a transmission platform called as Gridworks. India, we started a platform called Ayana. I can talk a little bit more about this going forward in this podcast. And we have started 2 new platforms in Southeast Asia. One is for rooftop solar initiative, which is more on the commercial and industrial part, which is a company called Sky Renewables, jointly with Idemitsu. The other one is an utility scale platform called as SARA, Sustainable Asia Renewable Assets, which is a joint venture between FMO, SUSI, Asia Energy Transition Fund, and BII, which is a brand new platform which has been set up in Philippines with the whole intent of doing energy transition projects in both Philippines and in Vietnam of larger scale. It's more a replicability of our learnings and the model which we established in Ayana into these markets.
Got it. So you're saying currently you've got 2 methodologies or 2 approaches, I should say. One is investing in funds, and the second one is direct investing to the individual projects or individual companies, or what you call the platforms. And is there a specific view in terms of how long these investments will be, or you don't have, is it 5 years plus exit, 10 years plus exit, or it just depends on the individual investment?
Before I answer your question, I just wanted to say there are 2 other main products of ours, which I just would like to amplify. Number one is debt. Debt is an important product for us. In debt, we do project finance for those individual projects, and we also do corporate debt. And other big product which we are nurturing pretty well in the region is called mezzanine. Mezzanine is neither a debt nor equity, and this is more providing funding at the holding company level, which will then be invested by the particular sponsor of the company into various SPVs underneath which they are building. So mezzanine as a product is a very important product, and with a number of marginally bankable projects in Southeast Asia, which the marginally bankable projects, to make them more bankable, mezzanine will be a very vital product. Mezzanine is a higher risk product than what debt is, relatively lower risk than equity. And it's a non-dilutive capital, which is particularly helpful for sponsors because they don't get diluted as a result of our investment. We are building this mezzanine book neatly and nicely within the region, and this is going to play a very pivotal role in terms of building more corporates within the region, really. And so that's one, those are the 2 main products. We also have some other products, few other products within our whole balance sheet, which we can do One is in the form of trade finance with commercial banks. The other one, which is more like a risk-sharing facility, we also do with commercial banks and institutions. So those are the two main products, which can be both funded and unfunded. Now, coming back to your question, I think a broad mission in Asia is fundamentally to be that particular pioneer, the forerunner in the whole area of climate change, given our ability to take greater levels of risks. So what is our shareholder and our board? If you ask them, what they're really telling us is, use our capital very effectively. Make sure that you don't crowd out private capital. You actually crowd them in. And they are telling us to take greater levels of risks. They're giving us different pools of capital, which is in the form of growth capital, which is in the form of catalytic capital. And they are saying to us, go and find new frontiers of investing to make sure that you're able to tackle climate change in conjunction with other institutions and partners. That's precisely what they're telling us. And that's precisely what we are doing. And we have the ability to take greater levels of risks. And that's what this region really requires. And Southeast Asia is actually, in the sense, all these markets are maturing as we speak. All these markets are very aspirational. As a result, they will emit more. And as a result of which, they need to draw a line and find a balance, like I said earlier, between emissions and their aspiration to become a middle-income nation and a high-income nation eventually. And that whole aspiration is only going to be done by more and more responsible investing.
Indeed. That's a good segue for the next set of questions, which is based on your experience and given you speaking to governments, you're speaking to other investors, speaking to banks, etc. What actions ideally can governments take to encourage investors to fund energy transition projects in the region, particularly at the early stages?
I think the impact that the climate change can bring to the region has resulted in governments actively promoting sustainability through various policies and initiatives, as far as encouraging businesses, including startups, to develop technologies that can align with each nation's climate goals, really. The vulnerability of the region, government initiatives, desire by business for increased investments, and the annual climate funding of $210 billion needed in Southeast Asia makes it an attractive proposition for investors to invest in the whole region's climate space. I think if you try and take an example of India, what they did way back in 2017-18, what they really did was to create a more favorable environment. They said that, look, we will do the land acquisition for you. We will make sure that the power evacuation is done through the transmission network from the particular site till a substation. We will make sure that the power purchase agreement is signed and all approvals are in place. Now, can we go through a reverse auction electronic bidding process? As a result of this whole process, they brought down the tariffs so low that the government benefited a lot as a result. Now, what did the investors gain out of this? They didn't have to go through the rigmarole of land acquisitions and the whole process and friction around it. And as a result of which, investors win the bid. They start installing the desired wind or solar equipments and making sure that they're able to create scale. So that created a more predictable environment in terms of making sure that you're able to execute projects in time. You're able to collect tariffs in time. In fact, they went ahead and said that, look, we will operate this under a central PPA structure, power purchase agreement structure. Now, that kind of an operating environment and the electronic reverse bidding process, which brought in a lot of transparency to the process, created a lot more confidence amongst investors to really pump in the billions of dollars into the country. Talk about the Canadian pension funds or the international sovereign wealth funds from Singapore, from Japan. Everyone brought in billions of dollars into the country. That's exactly what the Southeast Asian nations need to do. It's a journey. They are in the journey. I think they're really doing some of the most important examples in this whole journey is more the ASEAN Grid Initiative, which the governments have recently initiated, the Just Energy Transition Program, which the governments are working on in all these countries, as I said earlier, and also some of these programs pertaining to the fact that the energy storage programs and the green hydrogen and the various initiatives are there. I think the proof of pudding in all this is creation of scale. The proof of pudding is in making sure that the foreign direct investment comes into the country, not just debt, but real equity comes into the country. And there is scope to do a lot more in these countries. They are still very, very early in this journey. And there is desire from the international institutions to invest. And I think if they further, finesse it and create an operable environment, there is a lot of money to flow into these markets. But they are in the journey, but very early stages of the journey.
Actually, I'm really glad, Srini, that you mentioned the India example, because in my experience when I was a financial analyst back in the 90s and 2000s, I used to go there and I would get really excited by all of the initiatives, etc. And then there's no execution. And that was really disappointing. And it wasn't until like the 2010s that you saw that execution coming through. And I guess that's the principal answer to the question of how can you encourage investors is by giving very consistent and transparent policy. And there's going to be some hiccups. There's no country in the world where there's no hiccups. There's hiccups in Europe, there's hiccups everywhere else. And there's challenges as this is an evolutionary process in terms of energy investments. But I think the India example is not mentioned enough. And it's a very, very good learning example. Again, it's not perfect, but at the end of the day, what counts? Has your renewable energy or clean energy gigawatt count been going up? Answer, yes. Has foreign investment been coming in? The answer is yes. So as far as I'm concerned, it is a success story.
Sure.
I think that's a really good best-in-class example of India. Now let's talk about the kind of very complex subject, which is the intersection of inclusion and climate. How can that be addressed? And how does one factor in inclusion when making investments? Could you talk a little bit about this and perhaps provide one or two examples? Because I don't think it's a subject that is widely, frequently spoken about by investors.
No, that's a very, very important topic and an important topic and very, very close to our hearts as BII, really. Because if you look at, let me give you a little bit of background about our development impact framework. If you look at our development impact framework, which is, we call it a PSI framework, which is measurable, deliverable, and keeps us focused on our mandate. They include three important indicators. One is productivity, second one is sustainability, third one is inclusion. Now, what do these three verticals really signify? Productivity is about raising the productivities of economy so that they will be able to support a decent standard of living for all, building these economies of scale. Sustainability is about transforming the economy to reduce emissions, protect the environment, and adapting to climate change. Inclusive is about who benefits from this. This is sharing the actual benefits of this higher productivity and greater sustainability with the marginalized sections of society. That's what is inclusion, really. Now, fundamentally, I think inclusion is a very important part of what we do. Inclusion, it says who really benefits from our money. And I think it keeps us extremely targeted, like I said earlier. And I think that's where the real genesis of what we are doing comes from. Now, I think when we try and look at all three main pillars and our whole ambition, inclusion and climate change are deeply intertwined. Because addressing climate change effectively requires recognizing and addressing that this disproportionate impact it has on the marginalized communities and ensuring their meaningful participation in solutions, right? And I think, inclusive climate change can also drive positive social change and reduce existing inequalities over a period of time. Because, for example, it doesn't matter, because climate change affects all walks of society today. It doesn't matter whether you're rich or poor. It does affect all walks of societies, but the marginalized communities get affected more because they have to reconstitute and restart their life if they really get affected. And if you look at countries like Bangladesh, they're very vulnerable. Every year they get very vulnerable because of flooding situation, really. And I think most of our the whole intersection of inclusion and climate change is something, BII will not forget. And BII's main mission is this. And we keep this in mind, the whole effort which we try to take in the area of climate change. When we look at inclusion I think we'll be able to benefit a lot using intermediaries more than doing it directly. Because for us, because of our operating capacity and the minimum ticket size requirements and others, we try and use intermediaries more because their ability to reach the wider sections of society and also mobilizing other forms of capital and other like-minded investors is much higher. For example, we gave a $75 million finance facility with Habib Bank in Pakistan. This new facility will be supporting farmers and agri-businesses in Pakistan by providing increasing access to essential finance and enhancing their whole resilience to climate change. Now, this facility will be directed towards agricultural sector, which contributes to around 24% of Pakistan's GDP and employs 37% of the workforce. And this facility will mainly support the smallholder farmers, including those in the dairy and the poultry sector, which often lack access to finance. So the farmers vulnerable to climate change impacts will receive support to adopt sustainable practices, enhancing their resilience, yields, and income. The other example I could give you is a dairy company in India called Akshakalpa. We have provided equity support to this company. And in the process, what we have done is to provide a first loss type facility to a local non-bank so that the local non-bank is able to lend money to the underlying around 2,500 farmers to be increased to 5,000, where the farmers otherwise don't have access to finance because they don't have fixed hold properties. They only have cattle. And I think our ability to provide some kind of a first loss support, it increases the credit capacity of this whole borrower community and the lenders feel more comfortable about it. Now, so it provides them, these farmers, with more access to finance and they're able to multiply and grow their businesses. Now, I think the two main examples, I can go on with a number of examples which we will be able to say. Now, I think our indirect investments in what is also helping is we have supported a company in Nepal, which is to provide internet service ability, a company called WorldLink. This provides internet to both the valley of Kathmandu and to the outskirts of the entire country, particularly in very mountainous parts like Karnali and others, where I think their ability to have access to internet, farmers are able to plan their lives better. The dairy farmers are able to do this, and including the hospitals are wholly benefiting from this. The doctors are benefiting from this. So I think having information and the impact of it on climate change affects all walks and every bit of society in our lives today. So what we are doing through WorldLink is to provide them with that access to information. So similarly, we have a number of examples in BII we can talk about. And I think suffice to say that this whole benefit of this whole direct and indirect investments we make is to clearly recognize the marginalized society should really benefit from our investments. And we use a measure of $6.8, the World Bank standard, and adjust it to PPP terms in every country. And that particular section, which could be customers, which could be suppliers, which could be their employees, or any particular measure we do, that's why our whole PSI framework is all measurable, both on ex-ante and ex-post basis, really. And we make sure it benefits that section of the society.
Sure. I've got a couple of supplemental questions regarding this topic. Both of us come from a investment banking, commercial banking background. Mm-hmm. And we know that for a project to be sustainable, first and foremost, it must be economically sustainable. If it's at a loss, sooner or later, the wheels are going to come off. So when you, especially with regards to investing in funds and also the direct equity investments that BII makes, given the philosophy behind it, how do you take that into consideration? I mean, taking inclusion, just transition, et cetera, into consideration. The reason why I'm asking that, Srini, is because I'm sure you've heard about the mad debate going on about whether impact investment and responsible investment actually makes better or worse returns, which is a little bit ridiculous because it really depends on market cycles. If the markets are booming and everybody's interested in tech, you're not going to make a lot of money out of energy transition projects. Conversely, there's cycles, basically, the point I'm trying to make. So could you please address that? I mean, how do you think about these other factors when you are making your investment into the funds or the direct equity investments?
Thank you. It's an interesting question. Actually, we have seen over a period of time, after a few decades rather, that impact and returns can go hand in hand. I don't think they are conflicting objectives. The one important parameter in the whole exercise is you need to be a bit patient in the whole journey, right? I think we have found repeatedly that impact and returns can go hand in hand. It is not a conflicting objective at all. Second important point here is in Asia, particularly emerging Asia, it's very important you understand who you're backing, right? It's either the quality of your fund managers whom you back, or it's quote unquote what they call in countries in Asia the promoter or the oligarchs. In some countries they call it. Who do you really back? And how much are you aligned to their vision and objectives? That's important. Once you keep your whole alignment right, and if the ethical standards are met based on your anti-money laundering and bribery standards of the UK, I don't think you will go wrong within these markets in Asia. And look at how microcredit has grown in all these countries. It is multifold grown. I mean, who would have ever thought that people at the bottom of the pyramid would have a credit culture? They have a fantastic credit culture. They've proven this over a period of time, accepting the fact that if you overburden them, in some countries that has happened as well, then of course they have a problem. I think that's a problem in terms of the credit bureau and the way they function. So that has not been an issue at all. Even in terms of healthcare, I would say, you look at eye care, the number of cataract surgeries which are done in something like, millions which are done in India at such a rock bottom price is done by institutions like Arvind Eye Care, etc. $1,200, $1,500, they do a cataract surgery, done in masses. So the scale this can bring about can effectively bring down the cost of your operation and can turn this profitable over a period of time. You need to be patient though. This is not an asset flipping game. That doesn't work here. If you are willing to be patient, if you're highly focused on unit economics, if you're highly focused on making sure that your product is accessible to that sections of society, I think it's very difficult to go wrong in this. You will get it right. We have seen that repeatedly in areas like healthcare, in areas like financial services. Now, obviously, if you over leverage a business or you overburden a customer, you're bound to have trouble. And that is a culture which you actually create, right? That's actually, your overdoing of things. And if you don't do something as silly as that, you will make money in businesses. And eventually private capital will come in because they also need the mass impact it can create and the scale it can create really over a period of time. The second point I would like to mention here is, I think the benefit of institutions like us having access to multiple pools of capital. For example, we have this access to something called catalytic pool of capital. What do we do under catalytic pool of capital? The path to profitability can be longer, and we don't mind making a much lower return there, but the development impact has to be highly transformational. If you get that, in cases like WorldLink, for example, where we knew it will take a longer time for us to exit this business, we used a catalytic pool of capital. So that's one area which is very, very important. And I think if you use different pools of capital, since you got access to it, most of the development institutions have access to it, and the multilaterals as well. And it has to be channelized and used effectively so that the commercial lenders can eventually come. The third important aspect of this is using unfunded facilities very effectively, like guarantees, for example. And MDBs and DFIs can use the guarantee facility very effectively, where they are able to guarantee local financial institutions, which could be local banks, commercial banks, or it could be international banks operating in these countries, and the trade and supply chain finance. So those come on very handy when the liquidity, the capital adequacy requirements which these banks need to provide to these institutions, the underlying the lending of theirs could be lower, and that you enhance their ability to lend to this particular inclusive community by providing those guarantees. So that is actually a very, very powerful tool which one can use very effectively. So I would say DFIs, we have multiple avenues and pools which a smaller amount of capital can lead to catalytic impact on all these nations. For example, what did Ayana do? We invested $100 million in 2018. We mobilized $2.8 billion in the process by the time we exited the business. The $100 million of money which we put in, by taking that level of risk in 2017-18, helped us mobilize such a large multifold amount of money, and the impact it has in terms of creating scale of around 4.6 gigawatt of power. And that's what the catalytic money can really do. And that's the whole catalytic effect it can do. Yes, I mean, all what you do will not be succeeding. Yeah, it will be mythical to think that anything you do will succeed. It won't. There will be some failures in the process because you tend to take early stage risks. But that's par for the course. This whole investing mission is like that. You take a certain level of risk, you make a transformational impact. Ultimately, you need commercially sustainable business for it to create greater impact. Some of the businesses succeed, some of them may not. But, here we go.
Two last questions, Srini, if I could. One is, and they're kind of interrelated, based on kind of the work and the discussions that you have with counterparties throughout the region, where do you think we're at now? I mean, do you still see a lot of demand from investors? And I totally agree with your earlier statement that bankable projects are still relatively lacking in the region. But in terms of demand, do you see that in 2025 relative to, say, 5 years ago? Actually, that was COVID. Bad example. During non-COVID times, prior non-COVID times, do you see that there's been a very strong momentum? And related to that, and that's the billion-dollar question, over the next 25 years, how do you see the growth of energy transition projects in the Asia-Pacific region evolving?
Can you explain your first question a little bit more to me?
Sure. In terms of demand from investors, there's a lot of supply of capital globally. There's a lot of money that wants to invest into energy transition related projects. In terms of demand for projects from investors in the Asia-Pacific region in 2025 relative to a prior non-COVID period, do you see that as having increased, or is about the same, or decreased?
Well, taking your first question, the demand for projects is gradually increasing, I would say. As you and I just spoke, how do the economies evolve? The economies evolve in infrastructure when more and more platforms are there for them to invest. Right? And definitely, I think having a broader ownership structure, broader structure of creating more entrepreneurs who can build infrastructure companies and build more platforms will provide more bankable opportunities within the region. Just depending on few of the large industrial houses in countries to build infrastructure projects will not create scale. Of course, they are important for the countries, for these economies, but broad basing them is very important. And that's where I think a vibrant private equity or stock venture capital environment is very important, right?
So sorry, just to clarify, so you see demand from investors as still being quite strong for projects in the region?
Well, I think demand from investors, the appetite to invest is quite high. But however, they're not yet seeing the steady flow of bankable opportunities. But if you ask me if they have appetite, the answer is yes. It is definitely there. But they're not seeing steady flow of bankable opportunities. And that's exactly where a DFI like BII comes in and plays that credible role there, right? To answer your second question, I think in terms of energy transition projects in Asia, I see that there is an increasing commitment from governments in the region towards renewables. The scale is critical. And I also feel building local supply chain is also important, because I think you can't import everything what you want and create the renewable energy capacity in the country. You got to create your own supply chain of panel manufacturing, cell manufacturing, battery storage manufacturing, everything. These countries have to build the battery storage capacity and bring down the cost as well. And round-the-clock initiative is important if you want to create base load as far as renewables are concerned. Yeah. And I think there's some distance to go there. There are good signs, but early signs at this point in time. The other important point to remember is the commercial and industrial, Joseph, is very important, should be encouraged, because including open access. Because any kind of decentralized energy solution is critical, especially in an archipelago like Philippines and Indonesia. Talk about microgrids, very important in these islands. Because the transmission network still is very, very weak in all these countries. There's still a long way to go. The third one, of course, is about the grid strengthening. The ASEAN grid network, which is a major initiative to connect the electricity networks in all the 10 ASEAN nations. And what they're trying to do is to facilitate cross-border power trading and enhancing energy security and sustainability to have a fully integrated grid by 2045. That's a very important initiative. That requires a lot of capital expenditure to be supported by institutions like World Bank. That's an important part of one's initiative. You can't keep generating power, renewable energy power, without supporting grid. Yeah. Last bit is about the industrial transformation, which is again a very big business in Southeast Asia, because you've got the heavy industries. Steel, cement is one part. The downstreaming of the precious metals like nickel in Indonesia is an important part as well. So there is an enormous scope to transition those into renewable energy, because that's a big part of the emission, really. So in my personal view, I think, there are a number of these initiatives which are there. The proof of pudding is how much more FDI really flows into these countries. There are signs, but it's a journey. It's pretty early in the journey, I would say.
So I could qualify that as cautiously bullish?
Yeah,
would that be a good?
Yep, I would say.
Cautiously bullish.
Cautiously bullish.
That's
and
fantastic.
I think, if you look at international investors, let me just also add, they're not looking at deals less than, say, $150 odd million. Right? And those kind of large, big ticket transactions don't come without scale. And you have to create that scale and that vibrant environment for the international investors to come. Because these investors will not be writing small checks. That's not their DNA. If you look at the sovereign wealth funds and the international pension funds, they're looking at big tickets. I mean, some of them will say that, look, we're not investing anything less than 250 to 500. And infrastructure is a capital guzzler. Right? And you can't create that scale. So I think creating more and more bankable opportunities, scaling them up. And there are institutions and funds which are willing to write large checks, and garnering them will be very critical. So all these economies recognize this. And in a way, there is a recognition that recognition has to be transformed into action, and more consistent action, which results in deal flow.
Yeah, I think some Asian countries, and won't mention specific countries, but they've been kind of struggling from my perspective because they don't really have a very coordinated approach. I mean, the center, whether it's presidential palace, prime minister office, whatever it is, may have a view, but then to execute that throughout the bureaucracy is a big struggle. And I think I don't pretend to be an India expert, but I think that used to be the problem in India as well back in the 1990s and 2000s, where you go to 3 different government offices, say in Gujarat, and you get 3 different answers and 3 different views. Whereas now it's a little bit more, it still exists, of course, but it's a lot more coordinated. But then in some other Southeast Asian countries in particular, you still don't have that. And that to me is a big hindrance, because at the very beginning you were mentioning, policy consistency and transparency. That's, I think some of the countries do, but it's all about execution. So if you're putting up, it's a kind of form of red tape, these different offices doing different things, not coordinating with each other and so on and so forth. I think I heard that, for example, to get a solar project in the Philippines going, you need something like 100 steps. And the Philippines is one of the, let's say, better bureaucracies out there. They kind of know what the problems are and they're trying to address it. So that's probably the one way of unlocking more projects.
Well, I would say that, look, most important thing is technology. One of the reasons, since we have done projects in India, the countries where it's actually a substantial portion of our balance sheet, is perhaps because of the digitization efforts the government took of records. And that cascaded down to the village level. It's a journey, it's still happening, I would say. But in most parts of the developed parts of the country where most of these projects are happening, that's already happened. So that avoids any kind of the whole friction, bureaucracy in the process. And it's quicker as well. That is the only way to get rid of this and help you in terms of execution. And I think if you ask me, since it's proven and tested in a very large and difficult nation like India with the population, I see no reason why Southeast Asian nations cannot replicate the model and take it forward. And I think that's what, that can raise the level of confidence substantially in all these nations. I mean, how many platforms have foreign investors created and exited them successfully in the country is a great record in India. I mean, because it generates 200 gigawatt plus of renewable energy today, right? And a lot of platforms have been set up. Constant M&A keeps happening in those platforms. We just exited Ayana from a $100 million investment initially. We exited this for $2.3 billion along with two other investors. The National Infrastructure Fund of Government of India sponsored fund and a Green Growth Energy Fund which UK government also supported. And think fundamentally, so there are ample examples of one can cite in this particular journey.
120% concur. Srini, we at the end of the podcast, and I really abused too much of your precious time. Do you have any concluding remarks or some key takeaways?
Let me say this to you. I mean, I'll focus on climate because it's very dear to my heart and BIIs as well. Climate change is a journey. We have to tackle this through on multiple fronts. We have to tackle this. We do energy transition, mitigation, adaptation and resilience, which we didn't talk much about, keeping all sections of society. The one concluding remark what I want to say here is about blended finance, really. Blending is very important and much needed for tackling climate change. And blended finance brings together public, philanthropic and private capital into a single investment structure with each playing a distinct role and bearing different levels of risks and return, really. That's what the beauty about blending is all about. And I think MAS in Singapore has introduced a blended finance a pool of around $500 million under an initiative called FAST-B program. So when blended finance structures are well designed, these structures enables private investors to access opportunities that would normally otherwise fall outside their risk return thresholds. So unlocking new markets, diversifying portfolio, and generating measurable impact as well, really. And I think one of the points you made about the fact that how do we scale this business up? Particularly in slightly unproven areas, blending can play a very important role. Because once commercial investors are able to smell the fact that this is commercially viable and it can scale, they will come there like a bee, really. They will be in a beeline to come there. So I think we have an important role as a DFI to play there, and both in Southeast Asia and in South Asia. And I think I just want to leave a thought with you that, look, blending of all these pools of capital, it's still a long distance to go. There is a lot of desire amongst the philanthropy institutions to play a pivotal role in blending. And there are multiple pools of capital waiting for appropriate opportunities. We as BII have a great role in bringing them together, and we will continue with our mission in the region.
Fantastic. Thank you so much, Srini, once again for your time. I wish you very safe travels and looking forward to our next discussion.
Thank you so much, Joseph. Have a good evening.
Thank you.
Thank you for listening to this episode of the Asia Climate Finance Podcast. Please be advised that this podcast is presented for educational purposes only. None of the information provided should be construed in any way as investment advice. Always consult with a licensed investment professional before making any investment decisions. Additionally, please note that the views and opinions expressed by our guests are personal and may not reflect the views and opinions of their current or previous employers.